All right, everybody, welcome back to the Simple Markets channel. My name is JB. I'm a young entrepreneur and investor, and today I'm just going to be going over my investment portfolio. I'm only going to be going over 2 accounts today. I do actually have 4 of them, but these ones I'm going to be going over are my simplest as well as my longest term outlook accounts. I do have some that include dividends as well as individual stocks, but I'm not going to be going over those today. So my main focus today is going to be my main individual investment account and then my Roth IRA. Now, keep in mind, I am a young investor, so I do take a more aggressive approach compared to some. For those of you nearing retirement, you may not want to mimic a portfolio like this, but this will apply to the majority of people in their 20s and 30s, and if not even 40s, who are starting their investing journey. This is simply my outlook on my own portfolio, as well as the financial advisors that have kind of helped me put it together. This is also not financial advice, I have to say that before going into this, but I'm just going to be looking at the different ETFs that I hold, their expense ratios, the allocation, etc., and we're going to really dive into it here. So first thing I want to mention, there's individual investment accounts, and then there's a Roth IRA. I am from the United States, and a Roth IRA is a tax-averse account, meaning that all of the gains I make on this portfolio are completely tax-averse. However, the downside to that is I can only put $7,000 per year according to the 2024 standard. And previously it was $6,500 and even $6,000 when I first started investing into it. But that is why when you look at this, you will see a lot more mutual funds in this versus ETFs in this portfolio. And I can maybe dive a little bit deeper into that later. I don't want to confuse or lose anybody here. So the first thing we're going to be looking at is my individual account. And I'm going to break down the allocations, and then we might briefly just look at some of the individual funds in here. So to start off with the allocation, 25% of that whole account is within the Vanguard S&P 500. And for those of you that don't know, you may hear this all over social media or preached plenty, but it is an ETF that essentially just tracks the top 505 stocks in the US stock exchange. It's a fantastic ETF to hold, and for some people, this is their entire portfolio. And when you do compare this to many mutual funds, hedge funds, etc., you will actually see that the majority of hedge funds fail to even just beat the S&P 500 when it comes to returns year over year. So realistically, this is one of your best options when it comes to a base of a portfolio, or if you're brand new and want something very, very simple, simply putting your capital and parking it here and holding it for the long term can generate fantastic gains as time goes on. The S&P 500 is known for having an 8 to 12% gain on average per year. As you can see, over the 10-year span, we're looking at about 13% gains on average, followed by 3 more ETFs, which are allocated at 20%. Just to double back as well, if you are unaware what an ETF is, it's known as an exchange-traded fund, and all that essentially means is it is a basket of certain types of stocks. And this just helps diversify your capital automatically. Instead of buying the top 505 stocks in the market, I simply can buy this one ETF and get exposure to all of them in all different sectors. And those 3 stocks are VGT, Vanguard Information Technology ETF. The technology sector has been known for many years historically to see larger growth, and that is depicted here as well by the percent gains on average over the last 10 years. We could see about a 20% return, which out of this entire portfolio is one of the highest returning on average over a 10-year period. And then we have the Vanguard Growth ETF as well. Pretty standard. It's going to be large cap stocks that have expected growth long term. And that as well has a fantastic return over the 1, 5, and 10-year period, followed by VTI, which is the total stock market ETF. This is at 20% because I think it's a fantastic way to diversify. If you put 20% in here, you are exposed to all sectors in the market in the total US stock exchange. So it is not only a very safe investment, but you are going to diversify very, very well. And as you can see here, it does have a fantastic track record as well when it comes to average returns over the 1, 5, and 10-year periods. Last but definitely not least is going to be QQQ. Now, some of you may be familiar with this, but it is definitely a higher risk ETF to be investing in. That is why it is only 15% of my overall portfolio. And another thing that isn't the best about it is that expense ratio. It's going to be 0.2%. However, the returns speak for itself, and it does a fantastic job over the long term. However, because it is the NASDAQ 100, you are going to see a lot more volatility and risk involved in QQQ compared to these other more stable ETFs that I showed above. But overall, that is the majority of my investment account. Yes, I'm aware I don't have international exposure. I would much rather bet on the US economy than I would expose to international economy. Now, below, we're going to go over the Roth IRA a little bit. So this is FSPGX is the ticker symbol, and this is a large cap growth index fund. So I actually hold 35% here because it does tend to outperform the S&P 500, as well as a very stable stock, and I like the allocation that they have within the fund. In the 1 year period, it has returned about 30%. In the 5 year period, roughly 20%, and it actually has not been in operation for 10 years. So that is why you see this is the only one with a dash there. And then FXAIX, which is the Fidelity 500 Index Fund. Fidelity is actually my personal brokerage. One of the main things I like about Fidelity is their very, very low expense ratios. So FXAIX actually has the lowest expense ratio in the entirety of the market for any mutual fund related to the S&P 500. Vanguard is very close with their 0.03, but it's almost double the amount that the Fidelity 500 fund is. Now I'm going to talk a little bit about FXAIX and VOO and the difference here and why I have two separate funds that are the S&P 500 in two different portfolios. So what I mentioned was the Roth IRA is tax averse, meaning that you cannot be taxed on the gains on that account because the income you're putting in is already taxed. Compared to the individual investment account, where if I were to sell off shares of any of these ETFs, I would be taxed capital gains tax at that moment. So one of the issues with mutual funds, despite the very low expense ratio, which I really like, the mutual funds are typically actively managed, and every time that the owner of the fund wants to sell off shares of one stock to then buy more shares of another stock, that is a taxable event for everybody that is holding that mutual fund. So that is why within my Roth IRA, I prefer to hold all of these funds because it is not a taxable event within a Roth IRA. If I were to have these mutual funds within my individual account and say, because I prefer FXAIX, I replaced VOO with that, even though they track these same exact stocks, the way that FXAIX is managed, I would actually be triggering taxable events whenever the owner of that fund is adjusting the allocation and end up having to pay a lot more in taxes in the long term in capital gains if it were to be in my individual account. If we keep going here, we have FSGGX, which is just a global US index fund, So yes, I do have a bit of international exposure here, about 25% of that portfolio. However, as you can see, typically with international funds in the international economies, you are going to see a lower return year over year, only a 4% return on average in the last 10 years for international economy. When if you look at the total ETF for the US stock exchange, you're looking at about 12%. So that is a 300% greater return for the US economy. So that is why I don't typically like to have international exposure in my individual account. However, I do have it in my Roth IRA because this account is solely for retirement. And last but not least, I have FSELX. This is very similar to QQQ in the sense it is a very aggressive fund with high risk. So that is why I only have it at about 10% of this portfolio. However, you can see the track record is fantastic for it. It has 45% returns this year, 26.5% average in the 10-year period, which is roughly double the expected returns for something like the S&P 500 year over year. So yes, it is a very high returning fund. However, it is definitely more aggressive, so I have much less allocated towards it, as well as a very high expense ratio here. Now, on top of these, I mentioned I have two more accounts, technically even three. One of them is just simply the money market account, and because interest rates are very high at the moment, a money market is delivering a much higher return, to be specific, about 4.97% on your capital. So I do treat that almost as a savings account where I just park my cash in there for now and utilize those returns while I can. For some of you watching this video in October, the Fed has actually cut rates recently, which is going to drop the value that the money market returns at. So I may need to shift that capital over into a high yield savings pretty soon, for example, but we will see how that pans out in the longer term. And then I have another account that is a dividend portfolio, simply just based on returning that passive income from dividends. And then last but not least, I have some individual stocks that I like to pick and choose based on my expected growth in the 5, 10, 20-year period. If any of you have questions about building your own stock portfolio, you can always reach out to me in DMs. I put my Discord in the description so you guys can reach out and ask any questions that you may have. I can help you set it up. I've helped so many of my students set up their own portfolios as well. But I hope you guys enjoyed the video and gained some value from it, and I hope you guys can maybe take some inspiration from my portfolio. Once again, this is not financial advice, but thank you all for watching. I appreciate you tuning in, and I will see you guys in next week's video.